Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj, Ethiraj. The stock markets, both in India and worldwide, remained choppy through the last week ahead of the September 17th meet of the US Federal Reserve. Indian markets will be looking closely at the outcomes of that meeting, besides a host of other factors, including index of industrial production data and consumer price inflation as they search for direction. Here's a report.
Ahead of the US Fed meet, unmissable repercussions at the stock markets worldwide, alongside other possible reasons. Indian stock markets remained volatile through the week. The BSE Sensex ended down 1.35% from its weekly opening, though the Nifty actually ended up, gaining 1.5%.
Of course, India has its a unique place as far as emerging markets are concerned. It's more or less considered to be safe haven. So far, the disappointment on the local front is that our corporate earnings have not shown any sign of improvement.
Asian markets put up a better show due to positive cues from the US and European markets. The Shanghai Composite Index, Hong Kong's Hang Seng and Japan's Nikkei ended the week up. US indices felt a stronger positive sentiment. Standard & Poor's posted its biggest jump since July on expectations of an interest rate hike by the US Fed. The Dow and S&P were both up 2.1%. The Nasdaq was also up 3%. All eyes on the US Fed meet, now just a few days away. Bureau Report, Rajya Sabha Television.
Well, what indeed could happen in the coming week? We are joined by Saugata Bhattacharya, Chief Economist at Axis Bank, and Ajay Bagga, Chairman of OPC Asset Solutions. Gentlemen, thank you very much for joining us. So, Ajay, let me first understand, have the markets, considering that they did recover, at least in numerical terms, recovered from the largest shocks that we've been facing in the last few weeks?
I think so, and I hope so. On an optimistic way, I would say I hope so. But two very big issues remain in front of the market. One is the China slowdown. So is it a soft landing or is it a hard landing? So China determines a lot of the market. And second will be the Fed move. So does the Fed hike the rates? Does it postpone it because of the market turmoil? I think these are the two very big global issues, apart from our domestic issues, which are smaller.
Right. So let's understand the Fed, since that's going to influence or most likely influence the outcomes in the coming weeks. So walk us through the background first, Saugata. Why is the Fed rate being watched so closely? Why should it affect us or the rest of the world to the extent that we are also worried about it?
I'll start with the classic economist approach. So I think as far as I'm concerned, it's still about a 50-50. Why do we say this? I think from a US domestic economic viewpoint, I think they are more or less ready to start hiking. But I think exactly as Ajay was saying, that given the uncertainties, the global volatility that we are seeing, I think they are a little worried in terms of the two coming together with China, the big elephant in the room. And on top of which, if the Fed starts a hike.
So you're saying Fed may not have hiked or may not be sort of leaning towards a hike if China had not happened?
I would have almost an 80-20 probability of the Fed hiking if China and other global volatility had not happened.
Right.
And remember, it's not just China anymore. I think it's the entire range of emerging markets. Which is now, because of their exposure to China, because of their exposure to commodities and things, I think the entire
Brazil has been downgraded to junk.
That's right, downgraded to junk. Russia is not doing well at all. Many other emerging markets in the ASEAN region, because of their close links with China, I think they're also very fragile. So, I mean, in this environment, I think the Fed will definitely have an eye out for what their understanding is of global volatility. So, I mean, the bottom line in all of this is that, look, there are two ways. I mean, of course, very, probably the slowest climb out that we have seen in modern Fed's history. I mean, so it will be 25, probably only 25 for this year. We are seeing about a mean of 0.6, the Fed funds rate in 2016 as well. Very, cautious move up. I also somehow get the feeling that I don't know what the Fed's thinking would be, but from India's perspective, I think they might just get it over with and done, because otherwise the pot will keep simmering, keep bubbling along as we go. I mean, if they move in December is another tricky area to move, because at that point in time the profit booking and stuff happens in the US, so that makes it even more volatile. So my sense is if they think that global volatility can be contained and the wise men of China manage to stabilize their economy, I think there's a possibility of
So let me ask the layman's question. So why is it that we are so concerned?
The reason is, look, I don't understand equity markets. For one reason, I think other bond markets and currency markets seem to be relatively underpricing, still are underpricing the risk of a Fed hike. The US 10-year yields are still about 2.14. Volatility indices, other than equity, volatility indices are still lower. So at that point in time, markets still seem to be discounting the possibility of a hike in September. The reason I think is that traditionally the Fed has always tended to delay. That you remember in May 2013 when the first taper came in, and then after that the taper started. People were expecting the taper when the bond purchases stopped at that point in time. They also pushed that out far beyond. Even in the earlier tightening cycles, the increases were pushed back. So I think markets are expecting that even, given the fragility of the overall global economic system, the Fed might still. So because of that underpricing, that's the reason that we expect a little bit of volatility.
So Ajay, obviously Fed hiking a rate would affect capital flows, and we've already seen a lot of capital outflows, one of the highest in recent terms, particularly the month of August 2015. So is that something that could really affect us badly this time? Or as badly as ever before?
I don't think so. You know, and why do I say that? 22,000 crores went out, Govind, over August and the first week of September. 22,000 crores went out of our markets, and domestic institutional investors brought in 22,000 crores. So for the first time, domestic flows are equaling. And what are the big trends? One, LIC is a behemoth, other insurance companies. Third is we have 80 lakh mutual fund systematic investment plans who are putting in anything from 5,000 to 1 lakh per month into equity funds. That itself is about 3,500 crores, which the mutual funds start the month with, which they are assured that they will have to invest. And you have another 8 to 9,000 crores of inflows.
Right. So let me ask take a step backwards. A Fed raising a rate means money could potentially flow out of markets like India into bonds in the US, where obviously it would appear more lucrative. Now that is more of a domestic US economy situation, but can actually affect the rest of the world. To what extent is flows or are flows at this point of time pegged to what is happening in the US or not?
Okay, it's a very good, insightful question also, because is it the same pot where somebody comes into an emerging market equity and versus a US dollar treasury? I don't think so. So emerging markets get 3 to 4% of the big pension money. They look at India as a asset class in itself. That okay, it's a very high risk asset class, but the risk premium is also high. I'll get a higher return if I take this, but I'll put 2 to 3% of my money across emerging markets. The huge monies, like just to give you an idea, every year the global flows of FII, FDI all put together is about $1 trillion. India gets what we get about 15 billion, which is very high in an emerging market sense, but which is nothing if you compare it to the entire pot of trillions. So I don't think it's going to impact. And looking at history, what Mr. Bhattacharya was also saying, last 6 times that the Fed has raised in the last 30 years, what has happened? Stock markets are up 1 year down the line. Dollar is weaker, not stronger, because dollar becomes stronger before, leading up to the Fed rate hike. And gold has also rallied. Gold normally we thought it would get weakened. So it's actually contrarian post the Fed hike. So he was spot on when he said, let's get done with it. If they do it, it will give a lot of relief rally to the market. If they don't do it, again till December, we'll be on tenterhooks.
And for those who are looking at the rupee, you're saying even that could be a good sign.
Rupee, I think you can comment better, but if you look at the 1 year forward rupee, you're talking 69, 70 rupee kind of levels. So rupee is strong.
So let's pick up on both the currency as a general factor as well as interest rates, because a Fed rate in some ways will start influencing what we do in the domestic economy.
I'm not very sure from an interest rate point of view that Governor Rajan will be overly concerned. Of course, I mean there is a possibility of volatility, and that will have an influence.
Or those triggers are more domestic?
I think the triggers are much more domestic. the rupee will be a concern. That if I entirely agree with Ajay that I think whatever basket selling in terms of indices of emerging markets, I think that's more or less done. Although we don't have the numbers, I think it's more or less done. So now the focus is now moving into an India-specific allocation, risk allocation. We saw the current account numbers yesterday. We are positioned very well. As everyone now knows, I mean, India is pretty much one of the best places to invest at this point in time. Our sense of the rupee is, of course, I mean, there will be volatility. As if the Fed hikes, I mean, we can easily see the rupee moving at close to 68, probably even beyond. But I mean, we are looking at a balance of payment surplus for this year of about 35 to 40 billion US dollars, of which in the first quarter we've got about 11 billion or so. So we still have about 26 to 30 billion potentially coming in. So that will, I mean, although the RBI will pick it up some points, I don't think we will see a major retracement, appreciation of the rupee, because I mean, in the given export conditions in the market, they cannot allow too much of an appreciation. But I don't think we'll see a major depreciation going down. As of this point in time, whatever we understand of economic conditions, I think we should be working with a story of around 66, 66.5 over the next 6 months by the end of the year.
Right. So as the markets seek direction, and that's what we're trying to understand in today's discussion, what are the 2 or 3 things that are going to drive the sentiment going forward in the next couple of weeks, Ajay?
I'm expecting a Chinese fiscal stimulus, which will drive the markets very high. It will really boost the markets. This is 2008 redux, where China came in with a very strong stimulus, and it took off, it made the entire world economy take off. They are in a slowdown.
And that was a lot of that money went into infrastructure and building the western part of China and so on. Yeah.
And commodities took off. So they have to do something. Otherwise, China is slowing down, and they can't let it slow down because of their own domestic compulsion. So I think that is one trigger. Second is, what does the Fed do? I think that's a very huge trigger. So we have been telling clients, sit on the sidelines. You're not paid enough to beat so much volatility. If there's a big sell-off on 17th, leading into or on 16th, leading into the 17th announcement, which will be our, say, 11 o'clock our night time for us on 17th. So that could be some point to nibble a bit. But I think these are 2 very big factors which will come to play. Third, domestically, will be what does the government do now with the stalled reforms. So I'm hoping that the executive part, you know, where you don't need to go to parliament, at least if they move forward fast on that, if a preponed winter session, and that gets again dovetailed into November 8th, what does Bihar show up? I think that will also.
Right. So a bunch of domestic triggers, which in some ways we put the spotlight back on, is what you're saying. Saugata, last word. What are the 2 or 3 things that we're looking at economically in the next couple of weeks?
Ajay
to the extent that it's tied to the
absolutely.
Fed. Yeah.
Ajay has already beautifully defined, articulated the global risks, so that will play a role. But I think far more important, I entirely agree with him, that the key triggers will now be domestic. I think one of the ease of doing business that we had been repeating over and over again, they should demonstrate, other than whatever they are doing legislatively. If they can manage to move some bit on the GST, I think that will
Are you taking any succor from the revised IIP numbers or the new IIP numbers?
Well, I mean, we will be moving gradually forward on the growth curve. I mean, so as you saw yesterday, I mean, there are some indications of some industries beginning to move forward. But I think now the policy side, remember again, I mean, it bears to say this again, that India has never probably got this kind of an opportunity ever in its life. Our macros are so good relative to many of our emerging market peers that this game is only for us to lose. I do not think we should become complacent that India is now in a superb macro spot and things. This is the time to push through whatever reforms in whatever incremental fashion, because people now, investors now see that India will only move forward incrementally. No major reform push will come in. But I mean, this game is for us to lose.
And that's a wonderful note to end on. We've run out of time. Thank you so much. We're going into a break, but coming up on the other side, we talk about the new gold monetization and gold bond scheme. I'll be joined by Chandan, Taparia and Nimish. Shah. Stay with us. Welcome back to Policy Watch. In a bid to lure Indians away from the physical lure of gold, the government on Wednesday announced 2 new schemes, a sovereign gold bond scheme and a gold monetization scheme. The sovereign gold bond scheme will enable investors to buy certificates from the government, which can be later encashed for money. Here's a report on both these schemes.
It's an affinity that's ingrained deep into Indian mindsets and tradition. India consumes 1,000 tons of gold a year, most of it imported. Estimates suggest that Indian households, temples and shrines together have some 20,000 tons of gold stashed away. The government steps in to try and change that, make gold work for the economy.
मंत्री परिषद ने सॉवरेन गोल्ड बॉन्ड स्कीम को अप्रूव किया है। इस स्कीम के तहत एक्चुअल सोना खरीदने की आवश्यकता नहीं है, गोल्ड बॉन्ड्स खरीदे जा सकते हैं।
In addition, sovereign gold bonds can be issued as investment options in place of purchase of real gold. Gold bonds can be bought in units of 2, 5 or 10 grams or other denominations with a cap of 500 grams per person. The tenure could be 5 to 7 years to protect investors from volatility in gold prices.
इस बॉन्ड के ऊपर ब्याज भी होगा. There will be an interest on this bond which will be decided by the government from time to time, keeping the market rate in view. इसका पीरियड भी 5 to 7 years मिनिमम होगा. वो बॉन्ड के हिसाब से तय होगा ताकि जितने भी कंज्यूमर्स हैं जो खरीदते हैं उनको इसकी वॉलेटिलिटी से बचाया जा सके जो गोल्ड प्राइसेस में रहती है.
Massive gold imports were partly responsible for India's huge current account deficit that touched a record $190 billion in 2013, prompting the government to impose 10% duty on the import of gold. The government is now trying to achieve twin objectives by launching these schemes. It could curb gold imports into the country and unlock the value of gold already available. Bureau Report, Rajya Sabha Television.
Well, will Indians resist that lure? I'm now joined by Chandan Taparia, analyst at Anand, Rathi Financial Services, and Nimish, Shah, managing director of Fortune Financial Group. Gentlemen, thank you very much for joining us. Nimish, let me start with you. If you were to look at these two schemes in combination, what are your broad takeaways? How could it actually impact us or the economy in general?
Just taking a step back, Indians per se, are obsessed with three things: cricket, Bollywood, and gold.
Okay.
And not necessarily in that order.
Not necessarily in that order.
But they're obsessed with these three things. So this scheme, is going to be a game changer in plenty of ways. Now, when you look at this gold monetization scheme as well as the sovereign gold deposit scheme, the principal thing that the sovereign gold deposit scheme addresses is the current account deficit. You have your two things, your oil and gold, which have been the killer for the CAD. Oil, by an act of God or whatever, and let's not get into it because it's not a discussion on oil, has come down to extremely comfortable levels. The risk of deflation notwithstanding, but we won't get into that. And the gold which is being imported and which is a must for every household. Now, if you are able to, just pay and get a confirmation on your gold, it's like a FD on gold,
right?
And you're getting your gold back. It's going to be a game changer.
So, between the bond scheme and the monetization scheme, what do you see having more impact or relevance?
I think both are quite different. Though they are.
They're both gold, but actually,
but they are completely different. See, in the gold deposit scheme, it's basically, you're converting your physical asset, into your financial asset, with an option of reconverting it into physical asset. I mean, that's the biggest takeaway. It's not that you lose that gold with that receipt, with the deposit receipt. You have an option of reconverting it back. And all this is being done by a regulated agency, be it a bank, be it anyone whom the government nominates. And we'll have to wait for the fine print, because the devil, as you know, is always in the details. But I think it's going to be a game changer for Indians, and this is something which addresses Indians across the spectrum.
Okay.
This is not confined to the suit boot or the sobo or or the elite class, because even your household help has that 5 gram and requires that 5 gram of gold.
So we'll talk about whether the household help will actually convert his or her audience.
And I have views on that. So we'll
fair enough.
Come to
so Chandan, you had some views on how this could actually help other markets, particularly equities. Walk us through that.
First talking about all these schemes, first is the gold monetization scheme and second is the sovereign bond scheme. So I think this is a win-win situation for all class. First talking about the asset class, gold is a non-productive asset class, which gives return only on the appreciation, and which usually is known as a hedge against all your portfolio basket. But after launching this scheme, gold will be a productive assets, because in this gold monetization scheme, government will give the interest rate of 1.5 to 2%.
But is that attractive enough?
Yeah, and that is attractive. And one more reason of this attractive, that it is going to aim at the assets which is lying ideal in the hand of temples, trust and the household. And talking about the bond, in India we import around 900 to 1000 ton gold from the other countries. So after launching these schemes, we'll get the enough supply, which will give us lower volatility to the gold. Even because of that supply, the price of the gold may decline to the lower levels. Economy will get benefit out of that, because we'll get some surplus. It will also support for the trade balance, because in that time when we have enough supply from our own country, we no need to import, and that is going to boost the sentiment from the trade balance point of view also.
So Nimish, let me sort of, I think you took a step back, and let's take a further step back. How does this all add up, right? So the government will achieve some things, including, as you said, a healthy current account deficit. It brings out gold which is otherwise lying unused in someone's vault, and it brings it into the financial market. But there is a cost to it, and there are benefits too. So how does this add up? What are the benefits particularly?
See, one, it helps the government's borrowing program. So that's the single biggest. That's the single biggest thing. The other benefit is that, when first let's talk about the CAD impact. Now, if your gold import bill comes down, automatically your rupee gets some stability. The rupee was volatile on account of oil. I mean, and also let's not talk of the UN depreciation, because that's really, we have no control over that.
And that's a temporary.
And any country, you don't control your neighbors, what they do, or the world as large. But your gold import, which was, if you notice, Chidambaram was saying gold imports must stop, gold imports must stop, this something. So this is a scheme, which can effectively put a substantial end to this, Now, we'll have to look at the fine print as to, whether source of gold.
But there is a cost to it, and there are benefits too. So how does this add up? What are the benefits particularly?
See, one, it helps the government's borrowing program. So that's the single biggest. That's the single biggest thing. The other benefit is that, first let's talk about the CAD impact. Now, if your gold import bill comes down, automatically your rupee gets some stability. The rupee was volatile on account of oil. I mean, and also let's not talk of the UN depreciation, because that's really, we have no control over that.
And that's a temporary.
And any country, you don't control your neighbors, what they do, or the world as large. But your gold import, which was, if you notice, Chidambaram was saying gold imports must stop, gold imports must stop, this something. So this is a scheme, which can effectively put a substantial end to this, Now, we'll have to look at the fine print as to, whether source of gold, that's going to be questioned. There are lots of things.
Because the finance minister is already saying that this is not a black money immunity scheme extension.
Correct. But, I have a different take on that. Like, if I've got 5 grams gold, which is gifted to me by my father-in-law when I got married, and if I'm going to deposit that, I actually do not have a source to validate, I don't have a source to.
There's no timestamp on gold in that.
I don't have a source to validate so I think they will, my sense is that up to a limit, they might come with certain exemptions, and that could pave the way for a lot of hidden wealth, unintentionally hidden wealth. It's not a hoarding wealth. I'm not saying that it is, illegit or something. I'm by no means saying that, it's just, gold is the biggest gifting tool, Diwali, you will have gold coins, I mean, gold is a form of currency, you show, in this country, you show your love by the kind of gold you gift.
Right. And I'm going to come to that. I mean, the hurdles that one could face, particularly cultural. And, what could a scheme like this garner in your estimate, Chandan?
See, talking about the scheme.
Let's say if it were to, assuming the fine print was in your favor, I mean, and you were looking at an opportunity for your clients, if you could advise them in that direction, what would you say?
First we'll suggest to clients that better to go for this opportunity, because we'll get three kind of benefit. One, because of the interest rate, you'll get, if you are depositing your gold, you'll get some interest. The yield is less, but same time you'll get potential of the profit of the rising gold price. And second, you are getting profit of the taxation point of view.
Yeah.
Because
so no income tax, no capital gains, no wealth tax. Yeah,
yes.
right.
And one more
On
thing,
interest,
even a small investor can go into the scheme, because in the gold monetizers, even if you have 30 grams of gold, you can go into the scheme. And in terms of the gold bond, you can deposit up to 500 gram in a year. So that is for the the retail client as well as the HNI clients, and both the parties are going to get benefited, and same time the economy is also going to get the positive sign out of that.
Right, right. So Nimish, if you were to now look forward, what are the one or two key hurdles that this could face, and what are the one or two key benefits that could immediately, I mean, something that we could start seeing quicker?
So in terms of the hurdles, I think the biggest challenge with the government and the attendant agencies whom they appoint would be to get over the hurdle of education. I think this is something which, if they educate the mass, the Indian mass, see, I'll tell you,
because Mike, let me sort of supplement that question very quickly. Generally we are averse to financial assets. Right. I mean, I'm talking about financial assets in the nature of equity markets and so on. If this begins to resemble that, then will people find it as interesting or as attractive?
No, but this should not be marketed as that. What should be the sold? I mean, it would be a misnomer. It would be mis-selling if this is, because this is a fixed income thing with guaranteed.
So therefore, market it more like a fixed deposit or a variation of that.
It is like the Chandan Yojana was marketed. And let's not get into the numbers. And the numbers could be 20% exaggeration, 10%, and you and I are not sitting here to validate those. But if this is marketed properly, it would be a game changer. So I'll just take a step back, give you an example. About 4 or 5 years back, our research division, they keep on doing that rural surveys, on household incomes, and there's absolute rural thing, and that time inflation was moving and all, and that was the time when gold also moved up dramatically, between 2010 and 2013 and all. So, they were just interviewing these farmers and other people and all, and 8 out of 10 were saying that, sir, we are not really worried about the dal and the oil and the pulses and the vegetables. Our biggest concern is the gold inflation, because if I've given my older daughter 10 grams, I'll have to give my younger daughter also 10 grams, and that cost is, so see, it's psych, for Indians, gold is more it's an emotional issue.
So that's my last question. We've run out of time. So will we be able to cross that emotional hurdle?
If marketed well, 110%.
Okay.
And I have no doubts. This is going to be a game changer.
Okay.
It will take its time. I'm not expecting things to happen today, tomorrow, but it will take its time.
Chandan, just yes or no. Do you see this being transformational in the sense that we've been talking about?
Yes. Because see, there are different assets class, and I think equity is quite lucrative. But after this scheme, the traders will go for the gold as well to hedge against the inflation. And I think this scheme is positive for all gold and jewelries companies, because now the big companies, they'll directly buy from the government on the loan of that bond, and the small now investor, they also approach to the bank to take the same. So
but the key is but the key is, I think, as you said, position it well, market it properly, and it will surely catch the fancy
well packaged,
and that therein lies the key to it. Thank you so much, gentlemen. We've run out of time. We'll be back on Policy Watch next week, same time. Thanks for watching.